Right, so we've had a pretty chunky set of UK jobs figures drop this morning, and I think it's one of those releases that doesn't sound that exciting on the surface, but it actually tells you a lot about where the economy is heading and what that could mean for mortgage rates over the next few months. So the big headline is this: unemployment has now risen to 5.2%, and that's for the period October to December 2025. Now, on its own, that number doesn't sound catastrophic, but what matters is the direction of travel. It's up on the quarter, it's up on the year, and it's basically another sign that the UK economy is still fragile. And the reason this is happening isn't complicated. It's the same thing we've been seeing for a while now. Thanks to government policy, businesses have had higher costs across the board. Borrowing has been expensive, wages have been rising, energy costs have been unpredictable, and consumers are still cautious, because most households are just watching every direct debit at the moment. So what happens in that environment is that companies don't immediately go into mass redundancies. It usually starts much more quietly. They stop hiring, they freeze recruitment, they don't replace staff when people leave, they cut overtime, they scale back bonuses, and then eventually that starts to show up in the unemployment figures. And you can see that in today's numbers. The early estimate for payrolled employees in January shows a drop of 134,000 compared to last year. So that's fewer people on payrolls than we had 12 months ago. Now, it's not like the wheels have completely fallen off, but it's definitely a cooling jobs market. And we can see it in the employment rate too, because the employment rate is now around 75%, which is down on the quarter. So overall, fewer people in work, slightly more people out of work, and well, that's just not great. Now, one of the more interesting numbers in here is vacancies. Vacancies are sitting at around 726,000, and they're basically flat. There's been a tiny increase, but nothing major. And that tells you something important, because vacancies are kind of like a confidence indicator for businesses. If vacancies are rising quickly, companies are expanding. But if vacancies are collapsing, they're panicking. And flat vacancies usually means that businesses are just waiting. They're not in growth mode, but they're not completely shutting down either. They're in that kind of let's see what happens next mode. And that's pretty much the UK economy right now. Now, another point I think is worth mentioning, and I don't think enough people are talking about this yet, is that AI is also starting to have a real impact on job numbers. Not always through big dramatic redundancies, but through businesses simply deciding that they don't need to replace roles in the same way. So if you have people leaving admin roles, customer service roles, junior analyst roles, marketing roles, and instead of hiring again, companies are actually sitting back and thinking, actually, can we automate this? So I think some of what we're seeing now is also a structural change happening in the background, not just a cyclical slowdown. Now, if we look at wages, we can see that growth is still running at around 4.2%, and that's both including bonuses and excluding bonuses. So people will look at that and go, well, hang on, wages are still rising, so surely that's good, isn't it? But this is the key thing. Once you adjust for inflation, real wage growth is only around 0.5 to 1%. So yes, technically people are earning more, but they're not really getting ahead. It's not like households are suddenly feeling flush, and that's why spending is still weak, and that's why businesses are feeling the pressure. So what does all this mean for the mortgage market? Well, this is where it gets interesting, because if unemployment is rising and the jobs market is weakening, the Bank of England has to pay attention to that. They can't just keep rates high forever if the economy is clearly slowing down. Now, I'm not saying this guarantees a rate cut immediately, but it absolutely strengthens the case that cuts are getting closer. And that's why tomorrow's inflation data is going to be a big deal, because tomorrow we get the CPI release, and if CPI comes in closer to that 2% target or even lower than expected, then suddenly the Bank of England has a much stronger argument to cut the base rate at the next meeting, because at that point you've got inflation under control but the labour market weakening. And if you're the Bank of England, you're sitting there thinking, right, if we don't start easing soon, we risk choking off growth completely. And here's the key thing that a lot of people miss. Mortgage lenders don't price fixed rates purely based upon today's base rate. They price them based on where they think base rate is going. So if tomorrow's inflation print is favourable and the market starts believing that cuts are coming sooner, swap rates can soften, and if swap rates soften, fixed mortgage rates can drift down too. So weirdly, bad economic news can sometimes be good news for mortgage pricing. But, and this is the important warning, there's always a trade-off. Because if the jobs market weakens too much, lenders can also get more cautious. They start to tighten criteria. They become pickier. They reduce how much they'll lend based upon income. Or they become more nervous about certain sectors. So what you often get is a mortgage market that becomes more divided. If you've got a strong, stable income, clean credit, and you're in a secure sector, you'll probably still get decent deals. But if you're self-employed, commission heavy, or carrying higher debt, you might find lenders becoming a little bit less, well, flexible. And on the property side, well, what does this mean? Usually it means the housing market becomes slower and more price sensitive. Not necessarily a crash, but fewer bidding wars. Longer time on the market, more reductions, and buyers being more cautious because confidence is everything. So overall, these figures aren't a disaster, but they're definitely not a sign that everything's improving. They tell us the economy is still fragile, the jobs market is softening, and if inflation is coming down at the same time, rate cuts start becoming a very real possibility. Anyway, I'll pull all of this together properly in Friday's full weekly update, but tomorrow's CPI number could genuinely set the tone for what happens next, not just for base rate, but for mortgage pricing as well.